G'day, fools, and welcome to Motley Fool Stock of the Month. It is our very first one for 2026, brought to you free on YouTube. And it's cool because we get to peel back the curtain, not just on any old company, we do that on Stocks in Focus. That's worth seeing too, by the way, on a formal recommendation made by one of our Motley Fool investment services to our members. You get to look inside. So the sorts of companies, the sorts of analysis that we do when it comes to providing recommendations to our paying members. It is our marquee series, Motley Fool Stock of the Month, and I'm stoked to be joined by Motley Fool lead advisor, Ed Vesely. Ed, g'day.
G'day, Scott. How you going?
Mate, I'm very well. I hope you are too. So look, this is the beginning of 2026, our first one for the year. Kick off all of our other series as well. So here's the plug. If you're on YouTube, do me a favor, right? If you hit the like button down there, it makes me feel good, gives Ed a warm, fuzzy feeling. More importantly for everyone, it helps other people find the videos. And if you are enjoying it, if you're here watching, hit the subscribe button for me, hit the notification bell. Why? Because when we release something else, maybe it's what I've been reading later this week. Maybe it's Stocks in Focus next week, the next stock in the month. We do YouTube lives. We do all sorts of fun stuff on the channel. You'll be notified. And we figure if you're watching this, you probably do want to be notified. If you don't, that's okay. But if you do, if you're enjoying it, do us a favor, do yourself a favor. Hit those buttons. Again, it helps the algorithm, and those are all good things. All right, mate, let's get on with it. Let's get on with Motley Fool Stock of the Month with just one quick preamble from me, which is we can't give personal advice. This is only and ever general advice. So we say what we think. You decide whether it's right for you. It's also at a point in time. So yes, it's a formal buy recommendation right now. We don't expect it to change very frequently. Our recommendations don't change that often because we're long-term investors. But if you're watching today, a week, a month, a year, 10 years, 20 years, 100 years later, decent chance something might have changed. And if it has, we might have changed our view or not. Maybe this is still a buy in 2084. I don't know. But for now, at least, just please be mindful that the longer after this video you're watching it, the greater the chance we may have changed our minds. If we do, just for our members, we'll tell you inside the services, obviously. That's not a sell, by the way. I'm just saying it. It's not like we just put a recommendation and never bother updating it. We do for our members, but these videos are just points in time. Now, mate, let's talk about something that's dear to your heart. That is income, and income from shares in particular. We all like income, but dividends. You run Motley Fool Dividend Investor. You work with me on Motley Fool Everlasting Income. There's a theme, and this one is the Betashares S&P 500 Yield Maximiser ETF. There's a bit there. Break it down for me. What is this ETF?
Yeah, it's a bit of a mouthful. So it's not a company, obviously. Yes, we do have lots of companies on the scorecard, but there's also a few ETFs.
Yep.
Or exchange traded funds. So that's exactly what this is. And the code, by the way, is UMAX. It's a 4-letter code on the ASX. Now, you might think, oh, the S&P 500, it invests in the index. What it actually does do is it invests in a portfolio of stocks comprising the S&P 500, but it doesn't actually track the index. So that's something just to be keeping in mind. You could actually be wanting to diversify away from Australia, which is one good reason for considering an ETF like this, but it's not going to match exactly the S&P 500 if that's what you're looking for.
Yep.
However, it certainly deserves its place on the scorecard. It's actually done very well in the sense that it's not only achieved a good return and it's paid a quarterly distribution. You can also say too, it's beating the market since this was recommended back in 2015. So it was my predecessor, Andrew Page, who actually many of you might know. He recommended this, and if Andrew's listening, it's still on the scorecard. So
well done to you both. Well done to you both.
It's done very well. Look, I mean, there's really no reason for me to have put a sell on it. I don't know if it'll be around still in 2084. I'd like to think I'll be around in 2084 as well.
Oh, I won't
but
be.
Look, yeah, look, it's basically an exchange traded fund. Its value in terms of the size of the fund today in Australian dollars, it's worth around $301 million. So it's not a big fund. And some of the names that it invests in are very familiar. So we've got NVIDIA, Microsoft, Meta. So they're all technology companies. And then, of course, there's Berkshire Hathaway as well. Something that prospective members or even existing members would need to just remain cognizant of is the amount of information technology that's in the fund. It's around just under 35%. So that's quite high. That's neither good nor bad, except for the fact that the S&P 500 index itself is trading above its long-term averages. But the yield maximizer, this is where I suppose the magic happens. I'll get to that. Don't you worry. Yeah. So the S&P 500 is trading above its long-term averages. However, the ETF itself generates additional income. So it'll have some capital gains, and it'll receive dividends from the companies it invests in, but it also has an additional investment strategy of writing exchange traded call options. So it will basically sell an option to a buyer somewhere in the market. Might be a good. What they'll do is that the buyer of the call option will have the right to purchase specified shares at a set price. So that's the strike price
Mm.
on or before a fixed date. Now, I'll just use an example. I just looked up the share price of Microsoft just a moment ago. Well, it's obviously it's nighttime there, and they've just had a public holiday. But the share price of Microsoft when it last traded was $459. But if the owner of the call option had a strike price, say $400,
Mm.
that holder is basically in the money, and he or she could easily exercise that option at any time before the expiry date and buy the shares at $400, even though they're worth $459 on the market. So when that occurs, the fund would need to sell shares in the portfolio, but offsetting that is the income it receives from writing the call option in the first place.
Mm.
So the bottom line is that first of all, as I said, it doesn't invest in the S&P 500 in the index, but it will invest in any of the companies from the S&P 500. What you'll find that in a rising market, there's going to be more sales within the fund. But also there'll be potentially there's a lot more option premium income coming into the fund as well. So
Mm.
the distributions are higher. The benefits, I suppose, to the potential investor are that you've got reduced volatility. So when the market falls, it's buffeted a little bit by the income that's coming in.
Mm.
And yes, unfortunately, when the market does rise very strongly, it won't quite get those same gains. But you're going to just benefit from the I suppose the reduced volatility. But look, it's an ETF that will obviously attract dividend-focused investors or distribution investors in this case.
Mm.
And with the additional income that's coming in and it's paid quarterly, it's done quite well for the scorecard. I'll just give you some numbers here, Scott.
Go for it.
It was recommended back in October of 2015. It's been recommended twice. We've also got that in the everlasting income portfolio as well, so it's been
Mhm.
good there. But in that time since October 2015, it's paid out $11.86 in distributions. Now, the current price is around $25, $26. Should have looked at it just before the video. So basically what that tells me is that around 68% of your then purchase price has been paid back in terms of the distributions paid. Back then it was $17.48 when we recommended it, or when Andrew, a dividend investor, then recommended it. So $17.48, sorry, it's gone up to around 25, 26, but it's paid out a huge chunk of income. And that, at the end of the
2660 at the time of recording it. I've just looked it up.
2660. Okay.
2660.
So
Yeah.
it's in that time, it's risen from 1748 to 2660. It's paid out $11.86 in quarterly distributions. There's no franking involved because it's an overseas portfolio, but it's
Mhm.
been a very, very good payer of distributions. And whilst they will vary from one quarter to the next, they will go up and down, but there is a trend upwards, of course, over the long run.
Mm.
Maintaining the buy recommendation has actually seen it outperform the All Ordinaries by 10.4% versus 9.6% over the last 10 years. But interestingly enough, we've had a very good run with this stock. In the last 5 years, it's averaging closer to 14.5% per annum. I wouldn't say that's going to be guaranteed in the future, but if you can get close to around 10, 11% and get this quarterly income coming in at reduced volatility, it's not a bad deal.
So you kind of half answered my next question because you talked about what the company, the investment is. You've talked about
Mm,
how it's done. You've talked about the fact the price has gone up. Why is it a recommendation now? What do you like about it between now and the next maybe was it 11 years? Let's go forward another 11 years.
okay.
Why is it still a buy for you? What does it offer to your members and what does it offer to those watching the YouTube video today?
For sure. Well, first of all, the current yield is 5.4%. Now that will go up or down, but it's
Mm.
been consistently solid in the 5% range, sometimes over 6% if there's a drop in the unit price. So that's good. And as I said, it's paid quarterly. So you've got the
Mm.
income coming in. But I don't know where markets will go next. I do have a very strong suspicion that over the very, very long run, I'm talking 10 plus years, the trend will be certainly upwards. We hope so anyway, Scott.
Mm.
Um, but there's going to be a lot of bumps along the way. And when those bumps come, as we saw in March of 2020 during COVID, and many of you watching probably don't even remember the last quarter of 2018. That was also very tough 3 months. when those events happen and when the markets decline, you're just going to see reduced volatility. So I think it just helps you stay invested.
Mm.
And look, there's certainly a lot more volatile stocks that we've recommended here at certain services at Motley Fool. So there's going to be a lot more volatility elsewhere. But if you can stick to something, especially if you're a beginner and you want to diversify away from the Australian market, this is a very good way to do it. So I like it. Oh, look, the other thing too is that there is a fee, but it's going to cost you just under, it's actually 0.79%, which I don't think is too bad. I like to see at least under 1%. So it certainly does that in this regard. And remembering too that there's extra costs with the, I suppose the strategy itself of writing income and accepting that extra additional income, which is then paid out as distributions. But look, all up, I think it's good value, and I still think it'll be good value for the next 10 years or so. I mean, not to say I could put a sell on it next month, but I don't think I will be because it's been such a good performer and it's quite a simple investment.
Very nice, mate. Lovely summary. When we make a recommendation, and members watching will know this, but we make a recommendation at the Motley Fool, we say, hey, we think this is a buy. This is why. We're not trying to be balanced off 50-50. We're saying we've done the work, we like this thing. We think you should buy it. But we always add a but, which is, but these are the things you should know that are maybe have have a few hairs on it, maybe could go badly, maybe you should be mindful of when you're investing. This might not work out as well as we hope. We call it risks and when we'd sell or some version of that in all of our services. What are some of those, Matt? What are some of the risks, the downsides, the things people should be aware of, even if they are going to take that general advice and buy some units in this ETF? What are the cons? What are the risks? What should people be mindful of before buying?
Well, first of all, yeah, obviously, if you're investing in equities, no matter if it's this ETF
Mm,
or in other ETFs or directly with particular companies, this is going to be market volatility. So you just have to accept that up front. I do think it
mm,
will be less with this particular ETF, but it's still going to be there. And so if you do see a 15% decline, which could happen in a very bad market, even with this particular strategy, it could happen. And you certainly don't want to be shaken out of any investment that you make. So if you're going to be investing in equities in general, what we always say that the minimum period should be at least 5 years, but preferably much longer than that. I've been investing personally in the market for more than 30 years. So, and even with all the bumps along the way, it does help being invested
mm,
for the long run.
mm,
So that's the first thing. The other thing that I mentioned too is just that it is a little bit top heavy with information technology stocks. So I've mentioned Meta and Microsoft and so on, and there's others in there as well,
mm,
Nvidia. These companies look doing extremely well. If you really wanted to just drill down a little bit, you could think, well, there's a lot of AI investment going on in the United States and globally at the moment. Um, I just hope that the companies investing in AI will get the returns they require. So
mm,
if they don't, there could be falls in that sector perhaps in the future. I don't know. I don't follow too closely the IT sector in the United States. I do follow it, but not too closely. So I just think it's something to be cognizant of because it's look at 35% of the portfolio. And even in a general decline of tech stocks versus other sectors of the market, it could be an impact here as well. As I see, though, that'll be offset by distributions and offset by the strategy of writing calls. So it's a nice little balancing effect within the fund itself. But there are the two biggest risks, I would say. As long as you're invested for the long run, and as long as you've got
mm.
money that you don't need in the short run that can go towards an ETF like this, then you should be okay. But we'll guide you. And as I say, if the recommendation was to change it, it would be formally published by me on the scorecard. But given it's been around since 2015 on the scorecard, I'm not likely to make any changes too soon.
Who knows? But I think you're probably
Who
right,
knows?
mate. Let's wrap it up. Let's do the 30 or 60-second elevator pitch. Someone says, Ed, why should I buy the Betashares S&P 500 Yield Maximiser ETF? And you would say,
Okay, I would say it gives you instant diversification away from the Australian market. It does give you exposure to a faster growing market in the US.
hmm,
It does reduce volatility, and there is the additional income that you will receive to help offset any downturns in the markets when they occur.
there you go. The Betashares Yield Maximiser ETF. Have a look. UMAX is the code. There is one called YMAX, is a different code. Betashares make a different product to the ASX one, I think, from memory. So be careful. This is UMAX, the US S&P 500 Yield Maximiser ETF. We're talking about specifically today. Very clearly. I'm not saying we shouldn't do the other one either, by the way. I'm just saying what one Ed's talking about is this particular one. So all of the preceding comments about the UMAX ETF. Mate, thank you for sharing your time and expertise with our viewers. Thank you for the work you continue to do on behalf of our members as well, by the way. They're very lucky. We're very lucky to have you. Thanks for being part of it. Viewers, thanks for watching. Make sure you do the YouTube things, the like, subscribe, and the notify bell. And until next time, full on.